All right, in this video, we're going to start our discussion of straight line depreciation versus the accelerated method. So we're mostly going to look at straight line to start off with. So one important point to make before we even jump in here is that with the different depreciation methods, whether it's straight line or an accelerated method that we'll look at a little bit later, the total amount of the depreciation that will be recorded over the asset's life is the same. So the total amount of depreciation that will be recognized for an asset over its whole life would be the same, exactly the same, the total between the two methods, or the different kinds of accelerated methods versus straight line. The difference, however, is how much of that total is recognized in each period. In straight line, it's an equal amount each period, but with the accelerated methods, it's a different amount each period. More is recognized early in the life of the asset and less later in the life of the asset. So the total amount recognized is the same, but how much is recognized of that total each period is going to be different and vary from method to method. So with straight line depreciation, initially we had learned that it's simply the cost of an asset divided by its useful life. We're going to expand on that and just add a little bit more detail in this chapter to clarify that straight line. To find the straight line depreciation, it's actually, to be more specific, it's the cost of the asset minus any salvage value or residual value divided by its useful life. So salvage value or residual value, that's just what you estimate you might be able to sell the asset for after its useful life is up. So we just have to account that. Sometimes there is no salvage value, then it's just minus 0. But let's look at an example here. So here we have on January 2nd, S&G Wholesale Grocery acquires a new delivery truck. The truck costs $17,000 and has an estimated residual value of $2,000 and an estimated useful life of 5 years. So how would we record that depreciation? Well, the straight line depreciation for this, we start with the cost of the asset, so that's $17,000. Minus any salvage / residual value, which is $2,000. So we have $15,000 up at the top, divided by 5 years. So a whole year's worth of depreciation, if we take $17,000 minus $2,000, that's $15,000, divided by 5 years, that is $3,000 per year. And we could find the monthly depreciation. So instead, we would have divided this by 60 months to find out what it comes out to per month. But in this case, if we were to record that, we would simply debit depreciation expense. If this was for a year, a whole year's entry, debit depreciation expense for $3,000 and credit accumulated depreciation for $3,000. So that's how we find depreciation using straight line. Now, this asset here was acquired on January 2nd. So that's pretty much at the beginning of the year. But then a question arises, how do we account for depreciation expense for fractional periods? So this means, what if we didn't actually acquire that equipment on such a nice and easy date like January 2nd, which is the beginning of the year? How does accounting for that depreciation expense, how does that change? So there's 2 ways in which we can deal with assets that are acquired at other times during the year that isn't at the beginning. So the first thing we can do is simply round the depreciation computation to the nearest whole month, which we'll look at that in a second. So either we round it to the nearest whole month, or we just record half a year's depreciation. So this first one right here is if we were to use just fractional months or fraction of a year versus the half year convention. So this is half-year convention instead. So how could we apply that to this situation here using this first one right here? Well, let's assume instead that it was purchased, let's say it was purchased on November 1st instead. Okay, well, if it was purchased on November 1st, instead we want to ask ourselves, okay, how many months would we have had the asset for that first year? So it's all of November and all of December. So that would be 2 months that it was in use since I purchased it. So in this case, if we were using that first method, if we happen to purchase it during another time during the year, you take that $3,000 for a full year, or that's a full year's worth of depreciation. You take that $3,000 and you multiply it by the number of months out of a whole year that that asset was actually used, because we can't record a full year's worth of depreciation if we didn't actually use or have that asset for an entire year. So here we would multiply that by 2/12, or 2 months out of 12 months. So what would that look like? Well, 2 divided by 12, that's 0.167. We'll multiply that fraction by $3,000, and that gives us $500. So the depreciation we would record for that first year that this asset is in use is actually just $500. So that would be the depreciation expense for this new delivery truck if we actually had purchased it way later in the year. Now that's if we use that first method for accounting for fractional periods. So that was first method. But what if the company chooses to use the half-year convention instead? Well, the half-year convention says, well, if you purchase it at some time during the year, that's not the complete beginning, then you just assume that you had the asset for half a year. So in this case, if we had it for 2 months, but we're using the half-year convention, and we purchased it on November 1st, then we would just, let me clarify here, we'll include that same purchase date, purchased on November 1st, then we're just going to record half a year's worth of depreciation if we opt to use the half-year convention. In this case, you'll take that full year of depreciation that we had calculated, but multiply it by 50%, or 1/2. Well, half of 3,000 is 1,500. So the depreciation expense that we would record using the half-year convention on this truck if we had purchased it on November 1st would only be 1,500, compared to 500 if we actually use the amount of fractional months out of a whole year, if we use that method instead. However, if we happen to buy the truck at the beginning of the year, like the initial example, then the 3,000 we found is fine, because it was a whole year that we would have had that truck. But in the event that you purchase an asset at some other random time during the year and you haven't owned the asset for a full year, then we have to make some adjustments to that figure to better represent the amount of its cost that was actually used up. All right, so in the next video, we'll look at the declining balance or accelerated methods is another way of talking about it. We'll look at those different depreciation methods to follow.